you for joining us today. My name is Maria de Los Angeles Rivera, tax partner in charge here in Quebec Grand Thornton. And today I'm joined by Javier Oyola, tax manager of our department. The webcast we're going to be having today is going to be specifically dedicated to the changes that apply to the sales and use tax as provided by Act 72 of 2015. As you remember, we have been going through a tax reform process in Puerto Rico that started back in February this year with the file of House Bill 2329, which its purpose was to revamp the whole tax system in Puerto Rico. That bill was substituted by a new bill by the House of Representatives called the Substitute Bill 2329, which was killed in the legislature back in April. As you all are aware, we have now a bill that has been approved. Bill 2482 was approved and signed into Law 72 or Act 72 of 2015, which is not the full tax reform that was proposed originally by House Bill 2329, but provides certain specific and important changes both in income tax and sales and use tax. Today, also, after Act 72 has been signed into law and very close to its effective date of July 1st, a bill has been filed in the Senate, that's Bill 1433, which provides for technical amendments to Act 72. If we refer to the next slide, here we present a time frame of what has happened since February 11 when Bill 2329 was filed up to nowadays, where we have Bill 1433 providing for technical amendments filed on June 16, 2015. As of today, this bill has not been approved either by the House or the Senate, and we're waiting to see the progress on these technical amendments, which, as you might imagine, contain very important amendments to Act 72.
Well, thanks for joining us. My name is Javier Oyola, as Maria mentioned. As everybody knows, Puerto Rico is in the process of a transition period in which the current sales tax will be increased from a 7% rate to an 11.5% rate. The change is basically at the state level, which is increased from a 6% to 10.5%, and the combination of that increase with the actual 1% municipal sales tax is what brings the new rate of 11.5% effective July 1st, 2015. This new change is an amendment to the current Internal Revenue Code of 2011 instead of implementing a new code, as was the intention of Project 2329 that was killed by the government. As an additional important change to the Puerto Rico tax system will be in place starting on October 1st, and it's the imposition of a 4% tax on services rendered between merchants and designated professional services like CPAs, lawyers, engineers, tax return specialists, among others. This type of transactions were previously excluded from the taxable transaction under the sales tax. And the 1% municipal portion of the sales tax would not apply to these transactions because this 4% is considered a separate tax. And the Puerto Rico Treasury Department plans to have a separate return for these transactions. Continuing with the discussion, we need to define what is a taxable services, and it means basically any service rendered to any person. The term taxable service includes storage of tangible personal property, but excluding motor vehicles and every type of food, and also includes leases, including those operating leases of vehicles that are considered daily leases. Taxable services also include the development of computer programs, including modifications to pre-designed programs. Also includes an installation of tangible personal property by a seller to a third party, and also repairs of tangible personal property.
In this sense, we want to stress the importance of being sure what are taxable services and what is going to be subject to what different tax rate that we're going to be discussing today. Just to put you into perspective, please remember that the sales and use tax provisions that are in place right now will remain the same after June 30, with the exclusions of the topics we are going to be discussing today. So everything else that we do not discuss, like the taxation of tangible personal property or the taxation of admission rights or combined transactions, remains the same as of today, no change. The major changes that you're going to see are coming into place due to Act 72 are the ones on the rate that Javier just spoke about, the different tax rates, and the taxability of services. And that's why we're going to enter into the discussion of what are taxable services and what rate applies to what type of services. In the area of taxable services, proposed Bill 1433, remember, this is the bill that is proposing technical amendment. It has not been approved, but it's adding a very important taxable service to the definition of taxable services, and is that taxable services will include services provided by a non-resident person to a person in Puerto Rico. If you remember from our previous webcast, we mentioned that the Act 72 provides a new use tax on services received by a Puerto Rico merchant from someone outside Puerto Rico. And in that case, the Puerto Rico merchant will have to pay the use tax on these services. But the law really did not include these services as a taxable transaction, as a taxable item. So a very important technical amendment to this part is to include those services as taxable services, and that's what the proposed Bill 1433 is trying to do. Going then to the specific, what services will be then subject to the 11.5% tax rate? Well, the services that are going to be subject to 11.5% in the business-to-business environment, and remember, we're talking about on a business-to-business environment, are those that are actually paying the 7% that was included or introduced by Act 40 back in 2013. Which are these services? We have listed them there. It would be certain bank charges, collection services, security services, including armor services and private investigations, except security services provided to associations of residents or condo owners. These are not taxable at this 11.5%. Cleaning services, again, except those provided to association of residents or condominiums. Laundry services, non-capitalized repair and maintenance services of real or personal property. Again, except those services provided to associations of residents or condominiums. Telecommunication services, waste collection, except those provided to the association residents or condominiums. Operating leases of motor vehicles that constitute daily lease, except those that are equivalent to a purchase, are also subject to the 11.5%. Please bear in mind, these services were already subject to the 7% tax. The difference now with these services is that instead of being subject to the 7%, they're going to be subject to an 11.5% effective July 1st, 2015. So the first category we are discussing is these taxable services that were the ones already subject to sales and use tax. The only change in these services is the rate from a 7% to an 11.5%.
Starting on October 1st, 2015, the code provides some exclusions from the definition of taxable services, specifically for purposes of sales and use tax. Among these exclusions, we can mention the following. Services rendered to merchants, which are excluded from the 11.5 but subject to the 4% special tax. Designated professional services, excluded from the 11.5 but subject to the 4% special tax. Services provided by the government, educational services, including tuition costs, interest, and other charges for the use of money. We can also add insurance services and commissions, health or hospital services, and services rendered by persons which with an annual volume of business of $50,000 or less.
In addition, also, it will be excluded from the term sales and use tax from the term services or taxable services for sales and use tax from October 1st to March 31st, 2016, services rendered between members of a control group. As the law reads right now, these services rendered between members of a control group, these services to be excluded from the definition of taxable services, both merchants, the provider and the receiver of the service, have to be doing business in Puerto Rico. Proposed Bill 1433 eliminates the requirement of both merchants to be located in Puerto Rico. This will then allow for this exclusion for services received, for example, from a home office in the States or from a parent company in another country. But in order for this exclusion to be in effect for sales and use tax, there are some requirements that the proposed bill is including. The first requirement would be that both entities are subject to tax in Puerto Rico, or that the services that are subject to the special disallowance for income tax or AMT purposes. If you remember, the services that are received from a related party that are not subject to income tax in Puerto Rico are subject to the 51% disallowance of deduction for income tax purposes and to a special computation for AMT purposes. The law provides and allows the Secretary of the Treasury to issue certain waivers to the application of this disallowance. What this amendment is intending is that if you apply and you obtain the waiver for income tax purposes for the deduction of these expenses paid to a related party outside of Puerto Rico, then you will be subject to pay the 4% sales and use tax. Again, what this means is that you can now have both the deduction and the exclusion for sales and use tax. Again, it's included in the proposed Bill 1433. In addition, proposed Bill 1433 adds certain type of services to the exclusion from taxable services list. The first one is the security services, cleaning services, and repair and maintenance services provided to associations of residents or condo owners. When we analyze this exclusion that is being included in 1433, we conclude that, again, the purpose of this amendment is to exclude from taxation the services rendered to associations of residents or condo owners. But the way it's being included in 1433, it excludes them from the taxable service definition. Remember, the taxable service were those services that are already paying the 7% and are now going to be paying the 11.5%, that already excluded them from the taxation. So how this proposed amendment works is that it takes them out from the definition of taxable services but leaves them as business-to-business expenses or payments. And even though they would not be considered taxable services subject to 11.5%, because of the way the amendment is shown on this 1433, they will remain subject to the 4% in October 1st when the business-to-business taxation starts. Contrary, or on the other hand, last night, House Bill 2534 was approved by the House, and this bill provides for an exclusion of these services paid by the Association of Residents or condo owners from both business-to-business and taxable services. That is a better amendment. Under that amendment, definitely, these services will be totally exempt from sales and use tax. So just keep in mind that and keep watching House Bill 2534 that was unanimously approved by the House yesterday. Now is waiting on the Senate for approval. Another addition to the exclusion list from taxable services is the sale of transmission time on radio and television programs, including the rights sale of commercial time, including the commissions of the advertising agencies as long as the commissions are part of the invoice, and also production services for radio and television programs and commercials as long as these are produced in Puerto Rico. The term produced in Puerto Rico is not being defined in these proposed amendments.
What will happen starting on October 1st in relation to the business-to-business services? Every business-to-business service rendered to a person engaged in trade or business or in the production of income will be taxable at a 4% rate with certain exceptions. Those taxable services that are currently considered business-to-business services will not be taxed at a 4% rate. They will remain with the 11.5. Examples of these are security services, collection services, and waste collection services, among others. Services provided by the government will not be taxable. Educational services, including tuition costs, will not be taxable. Interest and other charges for the use of money will not be taxable. And we can also add insurance services and commissions, health and hospital services, and services rendered by persons with volume of business of 50,000 or less.
Okay, again, Bill 1433 is including an exception to the services rendered between members of control groups. Remember, again, under Act 72, the services rendered from one merchant to another merchant that are part of the same control group were required that both merchants were rendering services in Puerto Rico. This change that Bill 1433 is proposing is the same one we discussed before on slide 18. Again, the requirement of doing business in Puerto Rico is eliminated, but then two additional requirements are included. First, that both entities pay income tax in Puerto Rico, or that these expenses are subject to the disallowance and the AMT computation. Again, what this is trying to establish is that you cannot have both the exclusion from sales and use tax and the waiver for income tax purposes. In addition, Bill 1433 is also adding certain type of services to the exclusion list from the business-to-business services list. The first one is the designated professional services that are being excluded from the list of business-to-business. But again, remember, these will also be subject to the intermediate 4% rate that Javier already discussed. Bill 1433 is also including the exclusion of the sale of transmission time on both radio and television, including the rights, the commercial time, and the production of programs and commercials. Remember, they're being proposed to be excluded from the definition of taxable service, as well as now from the business-to-business services. So the effect of these two exclusions is basically that this type of services, the transmission time on radio and TV, as well as the production of programs and commercials, will be exempt from sales and use tax. They will not be subject either to 11.5% or the 4%. There are also two more inclusions on the exclusion list from the definition of business to business. One of those is the subcontracted services, and the other one is the services provided by a non-resident to a person in Puerto Rico. Again, in the case of these two types of services, after analyzing these proposed amendments, we have to conclude that they are being excluded from the business-to-business services list, and therefore they're going to be subject to the general rate of the 10.5%. We think this is something that is not intended. Probably the intention is that both the subcontracted services would not be subject to either the 4% or the 10.5%, because currently these services are specifically exempt after the issuance of a circular letter by the Department of Treasury that specified that subcontracted services, as long as the end client or end customer pays the sales and use tax, would be considered B2B and definitely not subject to taxation. And then regarding the services provided by a non-resident to a person in Puerto Rico, we understand that the intention is that these would be subject to a 4% and not the 10.5%.
So this slide 26 shows a list of designated professional services that are currently exempt, but they will be subject to a 4% tax rate after October 1st, starting on October 1st, 2015. The list shows agronomists, architects, CPAs, brokers, professional draftspersons, professional real estate appraisers, geologists, engineers, legal services, and is added, tax return specialists are added starting from October 1st.
Again, Bill 1433 is proposing an addition to the list of designated services to add services provided by non-resident person to a person in Puerto Rico that falls within this classification of designated services. Here we have a question mark because designated services are defined as legal services or any of the services that professions that Javier just mentioned that require registration with the board in the Department of State as required. Therefore, there is a question as to whether a person in Puerto Rico can hire these type of services from someone outside Puerto Rico and still be classified them as designated services. So we will have to see how this proposed amendment to the law comes out at final, because really it's hard to understand how we can have designated services provided by someone outside Puerto Rico and still be classified as designated services. In addition, there are three important amendments that are being proposed by 1433. They are specifically saying that the following three types of designated services, and this is very important, they're saying they're designated services, therefore they're not going to be classified as taxable services or as B2B services. They're designated services that will not be subject to the 4% and therefore will not be subject either to the 10.5 or the 11.5%. These are designated services rendered by persons with an annual volume of business that does not exceed $125,000. Legal services provided by members of the legal profession authorized by the Supreme Court to exercise the practice only with respect, and this is very important, only with respect to fees for legal representation in the courts, the Puerto Rico courts, the federal courts, or administrative agencies in Puerto Rico, and notary services. Services that legal firms or legal offices may render different from these, like for example, consulting services, financial services, or any other type of service that is not listed here, will be subject to the 4% tax. This will definitely create some complications from administrative side to legal offices to attorneys, because then they will have to account separately for their income depending on the type or source of the income they're receiving. The third change or the third exclusion from the term designated services is, again, a service that we have already explained before, is the services rendered by a person engaged in interior business in Puerto Rico to another person engaged in interior business in Puerto Rico that are part of the same control group. Again, they're eliminating the requirement of being in Puerto Rico, but you have the other two requirements, that both of them are subject to income tax in Puerto Rico, or that the expenses are subject to the disallowance or the AMT computation.
Okay. Act 72 also allows merchants dedicated to provide designated professional services, the list of slide 26, to use a cash method of accounting for purposes of sales tax for events that occur after September 30, 2015. These professionals will deposit the 4% tax collected when they collect the money from their customers. In addition, effective October 1st, 2015, in the case of services provided by a non-resident person to a person in Puerto Rico, the person responsible for the payment of the sales and use tax will be the person that receives the service in Puerto Rico. Before this change, they were considered business-to-business services exempt from taxation.
Here, we need to mention and to clear something. Act 72 specifically does not say that this rule of paying use tax on services rendered by a non-resident to Puerto Rico are effective October 1st, 2015. We are seeing this date of October 1st, 2015, that's why you see it in blue there, as part of the technical amendments of 1433. But it's very interesting that on a site that the Treasury Department has prepared regarding cambios to EVO or changes to EVO, there is a list of frequently asked questions, and in one of those questions they say that this provision of paying use tax on services rendered by non-resident persons to a person in Puerto Rico is effective October 1st. So it seems like the interpretation of the Department of Treasury is, even though the law was effective immediately when it was approved, the provisions of the use tax will be effective October 1st, 2015.
The section of the credits claimed by the resellers was also amended by Act 72. And now, starting on July 1st, 2015, every reseller will be allowed to claim 100% credit on the sales and use tax returns for the use tax that they paid on the purchase of items for resale. Remember that as of today, the credit is only 75% of the use tax paid on items purchased for resale. Now this will be increased to 100%. This is something new. We don't know the reason, but merchants with less than $1 million in sales during the preceding year will be allowed to pay 55% of the sales and use tax collected for the month of July no later than August 20. And the remaining 45% can be paid no later than the 20th date of September, October, and November. They are proposing like 15% each month.
In this sense, in the sense of filing and paying the sales and use tax for July on, we like to mention that merchants are still required to do the filings and payments through PICO system. PICO system has already been updated for these purposes. You are required to file electronically the returns. No paper returns are going to be accepted. And there are no additional registrations needed for this transition period. Again, remember, the registration waivers and everything that is in place as of today will remain in place for the transition period. So no additional registrations or waivers will need to be done or requested from Treasury. We still need to see what's going to happen to those waivers, for example, or those certificates are going to be expiring during the transition period. It has been, in the past, it was provided that these waivers, even though they had an expiration date within the transition period, they will last until the end of the transition period. But for these changes, we have not received any communications from the Department of Treasury as to the effectiveness of the waivers or certificates. So please bear in mind, check your certificates, check your waivers, and determine whether they are expiring soon or in the next month, because you will probably need to renew these certificates.
Another important comment regarding the credits is that resellers that are allowed to claim credits are two types of resellers: the holders of a reseller and municipal exemption certificates, and also the eligible reseller certificates. If you are not a holder of one of these two certificates, you will not be allowed to claim credits. So it is important to make that distinction, because if you are reselling some property, it is important to apply for one of these type of certificates.
Act 72 also provides some grandfather and transition rules for pre-existing contracts as of the effective date of Act 72. We're still waiting for official communication from the Department of Treasury as to how this transition rule is going to be applied, and the process that both merchants, the seller and the purchaser, have to follow in order to be able to benefit from these grandfather rules. In general, the law provides that retail sales that are part of executed contracts or bids that have been approved before July 1st will be subject to the sales and use tax rules and rates applicable to that item as of June 30, 2015. Please remember, this is not automatic. These contracts need to be registered at the Department of State. The process still has not been published, but on a webcast that the Department of Treasury held today, they discussed that it seems, and again, we have not seen the official communication from Treasury, that the registration process will extend until July 31st of this year. I guess because we are already on June 30 and the process has not been publicly disclosed. So again, as soon as we get official information from the Department of Treasury as to how this registration of these contracts will work, we will issue an alert so you are updated with the latest changes. The grandfather will apply only for a period of 12 months or the contract term, whichever is less. The law does not provide for an extension for this type of contracts. So you have 12 months or the contract term, whichever is less, to be able to benefit from the transition rules, for which you will not pay the rate of the 10.5% or the 11.5%, but the 7%. If the contract is a contract for services, and the law only includes taxable services, but the technical amendments bill also includes B2B services to other merchants and the designated professional services, the grandfather will apply only if the services are paid before July 1st, 2015. That means that if you have a service contract and you want to benefit of the rules before the changes, that is, instead of paying the 7%, instead of paying the 11.5, pay the 7%, or in the case of designated services or B2B services, pay zero tax against the 4%. You need to pay these services before July 1st. In addition, and we got information again from the webcast this morning, it seems that Treasury will require that not only the service be paid, but also the sales and use tax applicable to those services be paid before June 30, 2015. Again, today is June 24th, so we don't have too much time to analyze these contracts and determine whether we want to prepay or not. Again, the official communication from the Department of Treasury has not been issued, so if you are in a position or contemplating benefiting from this grandfather clause, please be on the look for a communication either from Treasury or from us on this aspect. The law also, Act 72, also provides a special grandfather clause for construction contracts, contracts for the construction of commercial, industrial, or residential projects. There's going to be a special registry in the Department of Treasury. It's called Works and Building Registry, where both the supplier and the buyer of either the services or the tangible personal property subject of these contracts will have to go together to the Department of Treasury to register the contract. Okay? It's not only the buyer or the seller. Both have to go and register the contract. Still, the process for this has not been issued. Again, please be on the lookout for that. If you register one of these contracts, construction contracts, you will have until June 30, 2016 to benefit from the rules and rates applicable to the property or the services as of June 30, 2015. Bill 1433 is also including the provision of a possible extension of 12 additional months for the contract in case the work has been delayed or the building has been delayed. You have the possibility of asking for an extension of 12 more months. These contracts will receive certificates of qualified contracts and waivers to the supplier, so they are not required to withhold or charge the sales and use tax. Again, from this morning's webcast from the Department of Treasury, it seems that the certificates and waivers will be issued or can be requested until July 31st, 2015.
Okay, the following are some of the most common penalties that are assessed by the Puerto Rico Treasury Department in relation to the sales tax and what they call the IBULOTO, that is the monitoring program of the Puerto Rico Treasury Department in relation to the sales tax. The first one that you will see in the list is the failure to register, which the assessments have been $10,000. Failure to display a merchant's registration certificate is $1,000. Failure to notify any changes or amendments to required information. We are talking here about addresses, NAICS codes, and everything else related to the certificate. It can trigger a penalty of $500. Displaying a falsified merchant registration certificate is a $5,000 penalty. Falsifying a merchant registration certificate is a $10,000 penalty. Improper advertisements, merchants telling that they will assume the sales tax or something similar to that. It can trigger a penalty of from $1,000 to $20,000. In addition, in relation to the admission right, failure to display a notice indicating that the sales tax is computed based on the admission of the price of the admission right can trigger a penalty of $100. Failure to collect the sales and use tax will be $20,000. Wrongfully collecting the sales tax, $100 for each receipt that you issue and is wrongly collecting sales tax. Failure to display separately the sales tax is $100 for each violation or each receipt. Selling, seating, or otherwise transferring the merchant registration certificate can trigger a penalty of $5,000. And providing false information to obtain an exemption certificate, to obtain a reseller certificate or something is $5,000. In addition, we have some Ibuloto penalties. We hope nobody here at the webcast has seen any of this. Basically, not issuing a Ibuloto receipt can trigger a penalty of $100 for each receipt that is not given to your clients. Refuse the installation or the use of a physical terminal can trigger a penalty of $20,000. Not using the physical terminal, disconnecting the terminal can trigger $20,000. Each of the penalties can be $20,000. And obstruct the inspections of the Puerto Rico Treasury Department can trigger also a penalty of $20,000. These are not the only penalties available in the code. There are some additional penalties, but these are the most common that we have seen in the past.
And also, these are no new penalties. They have been in the codes for many, many years. We wanted to refresh them, especially now that we have so many changes coming in the area of sales and use tax, just for you to be aware and just recapitulate and see if you're complying, with all your requirements, specifically Ibuloto. Ibuloto is still good, still there. It has not been eliminated. And we have seen a lot of Ibuloto assessments lately to our clients and friends. So we recommend you to review your compliance, to review your installations, to review if you have several locations, be sure that every location is complying because you can assess and face this type of penalties. Other matters that we want to go through as a recap, just to review them and let you know if something has changed in there or not, or how you're going to treat certain items. We have listed there several issues that we believe are very important to refresh. First of all, the filing of returns. No changes on the due dates and how they're going to be filed. As I mentioned before, all the returns have to be filed through PICO. And we have three types of returns.
We have the imports declaration, we have the use tax on imports, and we also have the sales and use tax return that is filed on the 20th of each month. Remember, it is important to file each return on time in order to avoid any assessments from the Treasury, because the failure to file any return can trigger penalties of $100 as a minimum, or 10% of the liability of the return.
And also remember, we mentioned in October 1st, when business-to-business and designated services start to be taxed, a different return is going to be used for those services. We understand and we believe the reason behind this is that under PICO, the general rate is at 10.5%. So in order to be able to use a different rate, a separate return has to be prepared for the services. So be in the lookout for October. So the first return will be due in November. For the services rendered in October, you will have a separate return for services.
Okay, it is important to mention that we will be sending a revised tax calendar before the end of the month. So you may see these changes in the revised version of the calendar. We have also another important point to mention, and is the return of merchandise after June 30, 2015. If a merchant receives returned merchandise after July 1st, related to transactions that took place before June 30, then he will have to amend the return of June as many times as needed to reflect such returns.
Yeah, and also, if you need to refund sales and use tax that you collected on this return merchandise, you will return the 7%, not 11.5%, because these were sales that happened before the effective date of the new rate, okay? Regarding the current bonds, if you are a bonded merchants are those that allow to defer the payment upon introduction of their merchandise to the next month when they file the sales and use tax return. If you have currently a bond, your bond covers your sales, but at the 7% rate. I mean, the 6% rate, because the bond only covers the state level tax. If you want to have full coverage of that bond when the new rate, the 10.5% rate, kicks in place, you will need to review your bond. You will need to increase your bond in order to be able to cover the time frame that you had planned to cover. If you don't increase your bond, you will not have as much time available as you had before to be able to defer the payment. So we strongly recommend all of you that are bonded merchants to review their bonds and decide whether you want to increase the same or not. If you have any questions, please let us know, call us, and we'll guide you through the process.
Okay, we have another point that is related to the layaways. We have seen some advertisements related to this topic and telling the people to take out their layaways before June 30. And the reason for this is that the layaways are subject to the tax at the rate that is in effect at the time of the final payment. And this is not new. This was in the code prior to the approval of Act 72.
And the last point we wanted to talk about today is a question that we have received, is what happens if I have a payable, if you're the buyer, if you're the seller, you have a receivable of an invoice that you have already sent before June 30, and you have not received payment, or you receive payment after June 30. The question is, should I include a tax of 11.5 or the 7%? The answer to that is that you don't have to do anything else with that invoice, because you already charged when you invoice it before June 30. You have already charged if the item sold was subject to the tax, the 7% tax. So the tax supplement has already happened, and you have already invoiced. The payment of that invoice after June 30 does not trigger an additional tax. So please be sure all the receivables that you might have as a seller, or the payables that you might have as a purchaser that have been invoiced already, and the services or the sale has already occurred before June 30, still subject to the rules before. So you don't have to do anything else or amend any returns to include additional tax on that. We also wanted to let you know that we are expecting several communications from the Department of Treasury on all these changes and how this process is going to happen. But as of today, June 24, 2015, Treasury Department has only issued 3 informative bulletins. The first one was Informative Bulletin 1509, and that was a summary of the changes included on Act 72. No guidance, no further guidance. The only thing stated there was a specific detail as to where or as to what change Treasury Department is intending to issue further guidance, but nothing in addition to the changes included in Act 72. This week we received 2 bulletins, Bulletin 1510 and 1511. 1510 was a notice to all merchants that they need to upgrade their systems in order to be able to collect the increased tax of the 11.5%. So again, not much guidance on that bulletin. And 1511 is the bulletin that promoted the review of the bonds by bonded importers in order to be sure that they are covered for the time they expect to be covered due to the increase in the tax. Nothing else has been issued by the Department of Treasury. Again, we're expecting several communications, specifically on the pre-existing contracts and the process regarding the registration of these contracts. We understand there are going to be 3 letters in that sense, and also other communications as to the process going forward. So again, as soon as we receive these communications from the Department of Treasury, we'll communicate to you all the changes and or processes and whether you need to do something really fast to be able to be grandfathered. Again, here we present a summary of the changes on the sales and use tax arena, both from the state level and the municipal level. Again, we have several time frames, several slots of time from now all the way to April of next year. As of June 30, or until June 30, 2015, the general rate is 6%. Designated services and B2B services continue to be exempt. At the municipal level, the general rate is 1%. That's how we get the 7%. And designated services and B2B are exempt. From July 1st to September 30, 2015, the general rate for sales and use tax at the state level goes up to 10.5%, but designated services and B2B remain exempt. The municipal level tax suffers no change, remains at 1%. From October 1st to March 31st, the general rate remains at 10.5%, but the new tax on designated services and B2B kicks in at a 4%. And from April 1st, 2015 on, unless the CATIC, the commission that has been formed to give recommendations as to whether we should keep the VAT as approved, brings another recommendation, we will have a general VAT of 10.5% or 0 rate, depending on the type of property that we're talking about. And designated services and B2B will be subject to the 10.5%. Please remember that under a VAT system, merchants are generally allowed to take credit for all the VAT they pay in their inputs, unless you are specifically excluded from being able to credit, like for example, merchants that sell exempt properties and all their sales are exempt will not be able to credit in general terms. There are some exemptions to that. Then you will be able to credit. That is not the case during the transition period. During the transition period, there is no credit unless you are a reseller. At the municipal level, from April 1st on, the municipalities are not going to be charging a VAT. They are continuing to charge a sales and use tax of 1%. And as we understand, designated services and B2B services are exempt from this 1%. As a matter of fact, Bill 1433 that we have been talking about during the presentation today specifically says that designated services and B2B will not be subject to the municipal 1% from April 1st on. With that, we are running out of time. We are going to attend your questions, the questions that we have received. We are going to attend them and answer them by email during the next couple of days. So don't worry, we'll go through all the questions we have received and answer them. We don't want to say goodbye without reminding you that we are going to be holding a series of 4 webcasts during the month of August. You have there the information on specific items of value-added tax. There are going to be 4 different webcasts with 4 different topics in each one. You can register for the 4 sessions, or you can register for different sessions separately. So review the information. We have already mailed it, but we'll continue to provide you more information on this. If you have any questions, please, you can email us at the Kibane Grant Thornton mail address, and we can answer any questions you may have. With that, we have run out of time. We thank you for your attendance today and hope to get your attendance to the next series of sessions of Webcast. Thank you very much, and have a nice day.